Okay, so back of the napkin analysis of side by side, using leverage, using a loan, and not using a loan for the purposes of depreciation and its impact net to your pocket. So using rough numbers, we're talking about a $2 million cash purchase for single family residence, but it could be multifamily as long as it's used for residential. That's generally done over 27 and a half years. So you cannot depreciate the land. Again, using rough figures, we're gonna say 20% is the land value, so that's $400,000. 80% is $1.6 million, which is the total amount that you can depreciate. Now, you can do this thing called cost segregation. Everything that's in the house, that's structure, and also the fixtures and everything, if it has a lifespan of less than 20 years, it's gonna be carpeting, it's gonna be the roof, it's going to be appliances. You can actually depreciate 100% of that in year one, which is this massive tax advantage. So now, $400,000 for the land. Now we're working over here with a $1.6 million that's attributable to the structure. So 20 years or less, again, doing it very conservatively. I said 20% of this, so $320,000. I just sort of rounded it to $300,000. That $300,000 is going to be able to depreciate in year one. The other $1.3 million, that's the structure, and that's what you're going to divide by 27 and a half. Didn't use my calculator, so basically divided by 30, I got $45,000, which I think is roughly about right. So you've got $345,000, so I just put $350,000. That's what you're gonna be able to depreciate in year one on this. If you live in California, top earner, between federal and state taxes, you're gonna be at about 50% taxes. So it's easy to figure out. $350,000 of depreciation in year one, you're going to get to save $175,000 cash in your pocket. And the remaining years, you're going to do $45,000 per year and roughly save, of course, $25,000, rounding again, to save per year. Now, the math on this thing, if you use the same $2 million cash to buy either single family or multifamily, but it's housing units, then you can buy very conservatively a $4 million piece of property, which will cash flow. I don't have to do all of this math again because it's literally doubling everything in here. And so then you'll have $700,000 to depreciate, and that will bring you $350,000 to your pocket in year one. That's why savvy investors, people that really are shielding income, are always using leverage in order to double what they can depreciate in year one and also double what they can depreciate in the following year. So that's it on basically a napkin.